let's get into the forecast. What's going to happen this year? Because 2023 was exciting. It was interesting, that's for sure. And we're expecting a better 2024. So let's just get right into it. It's going to come down to, as I got a new toy, so I got to play with my laser pointer. It's to come down to supply and demand, as you all well know. All right. First off, what really affects rates? Inflation, right? We've been hearing about inflation for quite some time now. All the numbers we see every month, there were big inflation numbers for quite some time. Now, what actually is the measure of inflation, right? We say inflation, but what does that mean? Well, the Fed uses two different measurements here, the core CPI, Consumer Price Index, and the Personal Consumption Expenditure, PCE. And actually, the Fed uses PCE more than anything else. That's the number they're using, and they want that number to be at 2%. Their target for this year-over-year number is to be 2%. Obviously, we're at 3.2 on that. So, hey, good progress from when we were at 8 and 9 not that long ago, right? So, one of the big things that affects this number is shelter, right? For the CPI, shelter is 44% of the core CPI in that calculation. So shelter cost is a huge piece of that, and it's about 21% of the core PCE. All right. Now, this is current CoreLogic blended rent year-over-year change, and what's this taking into account is current new rents, right? So somebody signing a new lease and then extending leases that are being extended. And they're probably raising as much as they can based on their localities, right? Because we're still seeing rents going up, but you can see they're coming a lot. They're not going up nearly like they were. It's only a 2.5% increase right now based on the CoreLogic blended rent, right? Which is great. This should be really great for our core PCE number. This isn't what the Fed uses. This is what the Fed uses. This is the shelter year-over-year change that they use, which is a 12-month rolling average. So you can see it's much slower to change, right? We can see it peaked here, right, about a year ago, and now we can see it dropping down. But when really the peak was actually back here, right, a year before. It's taken almost a year for that peak to adjust over, right? So we're looking at 6.7 on PCE and 6.5 on CPI as the numbers that the Fed is actually using, right? Which is kind of frustrating because it's not the numbers we want, right? But it's also not the numbers that we want them to use. So if we adjust for the lag effect, if we actually adjust for this, for the lag, core CPI is actually 2.2 and core PCE is 2.3, right? What's our target? 2%, right? So we're getting really close to the target based on the actual data that is out there. But like I said, Fed doesn't use that data, all right? So let's look at CPI and how they're going to measure it and how the numbers will change. Like I said, it is a 12-month rolling average, okay? So every month, the old number is going to drop off and the new one's going to replace it. So the old December number was 0.79, right? On January 11th, we got the new number for December. And I'm going to show you in a minute what that translates to because I do have that data. And then we're looking at for January, a 0.74, for February, a 0.76, right? All three high numbers are all going to be replaced in the upcoming months. February was when we're going to get the January numbers. March 12th is when we get the February numbers. So we're looking at this first quarter being pretty good for us in dropping inflation, right? And then we can look at the rest of the year. These are the numbers that will be replaced, 0.56, 4.5, 4.5, 6.5, 3.3. So you can see down here, we already see the numbers coming down. This is just last October, all right? So every month, we're going to get better and better because we know the actual housing costs are a little bit lower. Now, January 11th, right? That's when the numbers came out. This is the bond market. I don't know if you guys have seen this chart before. I look at this every day. In this chart, up is good. All right, so as bonds go up, rates go down. You can see we've had a nice trend since mid-October of rates cooperating and bonds going up, rates going down, leveled off for a little while, and we're kind of riding in here, which is not bad, right? This day right here, that's January 11th. We had a nice solid change. You don't see many days that big of a change, and we had a few here, and here. But for the most part, we see much smaller changes. So the market reacted very positively to the numbers on January 11th, like we expected them to. So that's good news that we're making progress there. This is the 10-year Treasury. This chart down is good. This is more a direct correlation to rates. So we can see on January 11th, rates dropped even further. We even got below a couple of key markers here, key support lines, which is great for us to see that, hey, the rates are responding appropriately. They're doing what we expect them to do, which is good news. We like that. All right. So expectations for inflation and the Fed. When is the Fed going to start cutting rates? Because the Fed has stopped raising rates, which is great. We're very happy that they stopped raising rates. Thank you, thank you, thank you. Because the Fed is always very slow to react to change. So like I said, their target is 2% on core PCE, right? It's currently at 3.16. So let's talk about numbers that are going to be coming up, all right? So in a few days, January 26th, we are expecting the month-over-month number to be 0.1% for December, all right? That will be replacing 0.39, right? That's a nice change, right? We're dropping off 0.39 and we're putting 0.1 in, which is going to move our core PCE year over year down to 2.87 from 3.16 in 1 month. That's a nice change because we're targeting that 2%, right? So now these are projections of what we expect inflation numbers to be month over month for the next 9 months, 10 months there. The Fed meeting on January 31 is when they take a look at these numbers and say, all right, what do we want to do, right? Here's the expectations. Here's what we're replacing, 0.39, 0.51. That's a good one, right? Dropping that off is a good one. 0.36, that's a good one to drop off. 0.34, 0.31, 0.29, 0.17. So not until June are we actually starting to level out with what we're replacing and stabilizing that number. But here's where it gets really interesting. March and April, 2.0 and 1.96, right at that 2% target rate. That's where the Fed wants to be. That's where their target inflation rate is. We are expecting some cuts before this time, but this is when we think things are going to get really good for us. All right, so this is basically the bookies numbers, for lack of a better term. This is what the market puts out saying, hey, this is what we think is going to happen, right? We think at the January 31st meeting, there's a 7% chance that the Fed is going to cut rates, right? So pretty much means we're not expecting a rate cut in January 31st. Just not going to happen, right? March 20th, there's a 68% chance that the Fed is going to cut rates, all right? Based on the numbers we saw, right? Right here, we're already making progress in March. So there's already a chance of coming down. Now, I did read some information yesterday. This number has actually gone down to 47% as of yesterday. Still 50-50 chance of rates coming down, of a decrease in rates in March, which at most would be 25 basis points. They're not going to do more than that. May 1st, right? Remember that April-May number? We're hitting right around 2%. 94% chance of the Fed cutting rates, all right? There's a 56% chance of at least 50 basis points, all right? Which is fantastic. This is great news. We love to see this. So what does this mean? April, May, June, right? We're going to start seeing these rates coming down. We're going to see rates drop, okay? Unless there's some major changes in the world, but based on all the projections we have and all the data we have, this is what we're expecting. Yes, knock on wood, right? And then June, a 91% chance of 50 basis points and a 53% chance of 75 basis points. This is great, right? I'd love to see a 75 basis point drop, right? That would be huge. It'd be a nice big thing. And then they're basically expecting every meeting through the end of the year, there's going to be a Fed cut, right? This is all good news. So what does this mean? So what is April, May, June for you guys as realtors? Springtime. And what happens in the spring? Everybody's listing, right? The curb appeal. This is also when people are thinking about, hey, we want to move at the end of the school year, so our kids we're in the new house by the beginning of the next year, so we're not moving our kids during the school year, right? So this is good news. So we want to be gearing up, before April to be ready for the influx of customers we're going to be seeing, right? All right, the Fed dot plot. I mean, I like charts, right? It's kind of what I do. I do numbers. This is a chart that all 19 Fed members place their dot independently and anonymously based on what they think is going to happen, okay? So this is each individual prediction. So 2023, right? Well, this is based on the actual data of what did happen, right? This is based on what does each member think is going to happen, okay? So we got 2 members who think there's going to be 0 cuts. We got 1 who think there's going to be 25. We got 4 who think there's going to be 50 basis points. We got 5 who think there's going to be 50 basis points, 6 who think there's going to be 75, and 4 who think there's going to be 100, and then 1 person way down here thinking there's going to be 150 basis point cuts. Great, love this person, but statistically, let's drop this one, let's drop that one, right, to cut off the top and bottom. That still leaves us, 6, 11, 15, 16 of the 19 members think there's going to be at least a 25 basis point cut up to 100 basis points this year. All right, that's good news. These are the people who actually make the decisions, right? These are the ones who actually make the cuts. So it's good to see what they're thinking, what they think is going to happen. Now, looking at their expectations for 24 and 20 or 25 and 26, you can see rates trending down, trending down, trending down. Fantastic. We love this, right? This is good for a couple of things. First off, if you get a new home buyer, right? First time buyer, get them into a house now, right? 2 years later, all of a sudden upgrading to a new house seems like not a big deal because their rate's actually going to be lower, right? You got people who are, then you've got buyers who are downsizing, right? Retired folks, kids are out of the house. They want to downsize. Same thing. As time goes on, it gets easier and easier because as you know, right now, everybody's got, 3% or less. Nobody wants to leave that rate. They want to leave their house. They don't want to leave the rate, right? I get it. But if the house isn't right, the house isn't right. So good news. The other thing is if they buy right now, what's going to happen in a year? What am I going to do in a year and a half? I'm going to pick up the phone. I'm going to call them and say, hey, rates have come down by a full point and a half, whatever it is. And this is how much you're going to save each month. And I'm going to refinance them and save them $200, $300, $400, $500 a month, right? So the trend is our friend right now. This is good. This is the expectation. Again, this is from the people who make the decisions, right? So, all right. Other things that affected us last year, the Fed balance sheet, their outright holdings. How much are they holding, basically? In 2023, they were selling off. Now, 8.5 trillion was their peak at 2022, which you can see is way above the trend, the standard, where we normally have been keeping things since 2008. Right now, 2008, 2009 was crazy times, right? So if we get out of there, we've been fairly steady in this 4 trillion range, right? We were up to 8.5 trillion, and so the Fed's like, we need to start selling these off. So they start selling them off last year, which sounded like a good thing, right? But that actually hurts rates. You're selling too much, right? When you have a lot of product on the market, right? Prices go down. As prices go down, rates go up, right? So let's talk about what really matters here. And what they're looking at is our balance sheet versus GDP. This is the important number here, right? So average range from 14 to 18, about 22%, right? Which is where a good number where we should be. Pre-COVID, we were at 21, great. And then the world went to hell. And then all of a sudden now, April 2022, 33.2%. It's a big jump. That is a significant increase, all right? So they started selling off in 2023. Now, as of recently, we're down to 25.6%, which is good. That's a better number, but it was costly to get there. It hurt rates to get there, right? Here's what we expect to see coming over the next year. Lots of numbers. Here's the important column to look at. 25%, 25, 24, 24, 24, 23, 23, 23, 22, 22, right? Getting down to that 22%, which is where we want to be. What I like about this, though, is it's a slow, easy sell-off. It's not going to be a big, massive sell-off. It's a slow, gradual sell-off that won't cause rates to go up. All right, so this is good news. It's based on what we expect to happen. All right. So yeah, we're looking at, as we get into the summer, more downward pressure on rates. So we already talked about spring rates coming down. Now we're seeing another factor going to be pushing rates down again in the summer. All right. So all good news. All right. Now, if they sell off too much too fast, they put us into recession. And every time a recession happens, which is these bars, right? These vertical bars are recessions. And then you can see rates dropping, 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 right? So in a weird way in my office, we're kind of horrible people in that we kind of cheer for bad news and recessions because rates drop, right? We own it, which is fine. It's not, but it's looking like the Fed is doing a decent job of putting us into a soft landing so far. Now, it's hard to tell because we never know we're in a recession until 2 months after we're into it. They don't call it until we've been into at least 2 or 3 months. So we'll see how this plays out. All right. What's going to happen, right? So 30-year fixed rate mortgage. We're expecting rates to be in the mid 5s to high 6s this year, okay? We're already in the high to mid 6s right now, okay? If we get under 6%, right, all those move-up buyers like, oh, yeah, okay, 3% to 5% doesn't sound that bad, right? Granted, it's 3% to 5.75, but I remember my wife and I bought our first house in '05. We got 5.5%. We were excited to get 5.5 back in '05. It was a great deal, right? So getting into the fives really changes everybody's mindsets. But we were in the 2s and 3s and 4s for so long, we needed a year for people to rewrap their brains around the fact that those are gone. But 5.5, 6, those are reasonable rates we can work with, okay? The 10-year Treasury, went too far. We're expecting that to be 3 to 4%. Now, the way this basically works, you get your 10-year Treasury, and the spread between the Treasury and actual market rates is about 2% most of the time. It's been 3% for quite some time now, for the past year or so. So that's been hurting things too, is that spread has been higher than it should be. So we're expecting spreads to come back down. So if we get down to 2% and we're at 4.5, we're at 6.4 for rates. If we get down to 3% and we have a 2% spread, now we're at 5% rate. Imagine a 5% rate, how many clients of yours would be just jumping off the fence and getting into the market, right? It's great, it's fantastic. Of course, that's gonna drive prices up, but we'll get that. All right, inventory. You guys know this, right? There is not much out there. Yeah, that's good. So let's, 2013, and this is nationwide, we had 2.25 million homes available. Then you see this trend just dropping. 2022 was very few homes available. Remember that year? Multiple bids. It was crazy times. And then 23, we saw a few more come on board, right? And we're expecting to see some more come on board for 24 as new construction keeps trying to catch up, right? But as you know, contractors can't get subs, so they can't build as fast as they want to. So inventory is an important number, but also what's really important is household formations. In the United States, household formation is basically when somebody is moving out of their parents' house and getting their own place, either renting or buying, right? So 2013, formations weren't that big and plenty of completions, right? So lots of available inventory. And then we see this shift. All of a sudden it's like, oh, we got a lot more formations happening than we have, we have a lot more household formations than we have inventory available, right? So we can see this just tight inventory, especially here in Central Oregon. I mean, entry level in this town, what is it? What are you going to spend if you want to get into this town and not have a manufactured home? 5 to 6, yeah, 5.5, 6. It was 5 a couple months ago, right? We're already getting 5.5, 6, right? So again, builders are doing the best they can. We all see a lot of stuff coming on, but they can only build so fast, right? Especially when we get below freezing, ice storms. And I took a fall on Saturday. Oh, no. I have a really nice bruise on my butt that I'm not showing anyone. My wife laughed at me, so it's fine. Okay, so let's talk about the elephant in the room. It's like, sure, rates are coming down, but houses are still really expensive, okay? Now, this example is nationwide. This is not Bend local because there's no way a $240,000 loan is happening in Bend, right? Now, this was, back in 2021, if you borrowed $240,000, 2.875, your P&I payment, principal and interest, not including taxes and insurance, you're looking at $1,000. Income, roughly, to qualify for that, is roughly $4,000. You could actually make a little less than that depending on the situation. But for this scenario, we're just using this number. All right. Now, you're looking at borrowing $280,000 at 6.625. Your payment is $1,800. That's an $800 increase on your monthly payment, right? That's a chunk, right? And all of a sudden it's like, wow, I got to make $800. I got to make an 80% increase in my income to qualify for this. Well, not really. That's not actually how the math works. To make an extra $800 on $4,000, you only need a 20% increase in your income, right? And incomes have risen 15% since 2021. Right? We've all seen it. We've seen minimum wage hikes. We've seen all kinds of different labor disputes and forcing up wages, right? Which is great for home buyers, right? It's also inflationary, but where's the balance? So we're not quite where we want to be. We're not quite at the 20% increase, but that affordability gap isn't as bad as it looks when you do the math on how much more do you actually need to make to qualify for this home, right? All right, so nationwide appreciation. We're expecting 4.5 to 5% appreciation nationwide. What do you guys think Bend will be in 1 year? From right now to December or January of 2025, what do you think the appreciation in Central Oregon is going to be? You guys would know better than I do. I don't have a number. I'm asking. I really don't. You think it's going to be more than 5%? 6%? Yeah, 5, 6, 7. I think that's realistic, especially as rates come down and all those buyers who've been waiting start flooding the market. builders aren't building any faster. We will see some more inventory for people who sell, which is good, but I don't think we're still going to see enough inventory to cover all the extra buyers that are going to be coming into the market. Transaction volume up 15 to 20%. Who wants to do 20% more business than they did last year? Yes, yes. Okay, so what does all this mean on payments? Because that's the real number. That's what clients care about. What's my payment? What's my payment? I can give them all the numbers, your debt to income ratio, loan to value, all that stuff, but it really comes down to what is my payment going to be? And that's what I always ask them. What's your comfortable payment? I can tell you what you qualify for, but if you're not comfortable with that payment, then let's not even bother. Let's do the math on where you want to be. And sometimes they'll tell me their payment, and I do the math and say, all right, this is how much you can buy on that. They're like, ooh, okay, well, let's redo the math, right? So let's talk about, this is really hard to read, sorry. That's 7%, 6.5%, 6%, 5.5. So as rates coming down, moving across the chart. This is principal, interest, taxes, insurance, estimated $600,000 home with 5% down. Okay, so I went kind of bend here, right? So 600. At 7% interest rate, your payment is $4,310. Okay, who wants to have a $4,300 house payment, right? Not me. 6.5, you come down to $4,100. 6%, you're down to $3,900. You broke the $4,000 mark. And at 5.5, you're down to $3,700, saving $555 from the higher rate. All of a sudden, it's like, oh, that's starting to look a lot more affordable for people. Okay, so this is where the real numbers matter, right? Over time, over 5 months, $43,000 saved over here with this rate. And over 15 years, and this is basically mortgage insurance and interest paid, $550,000 paid versus $422,000 paid. 128,000? Yeah. $128,000 saved in 15 years. You stay in that home and stay in that mortgage. That's if you don't even refinance, right? That's if you stay at that 5.5. Now, granted, if you get a 5.5 to start, you probably won't be refinancing anytime soon because we're not likely to get below 5.5 anytime in the foreseeable future, unless the world goes to hell again, which who knows, right? Why am I not weird? Okay, so we talked about this. You gonna go? There we go. It's showing that it moved over here. Oh my goodness. Okay. Gotta love technology. Okay, so effective declining rates on purchasing power. So as rates go down, can people buy more, right? And this is based on same scenario, $600,000 purchase, 5% down, right? And this is based on their did some qualifying, it's based on a certain income. This is what they could qualify for. So at 7%, purchase price of 600, loan amount 570, right? 6.5, purchase price 631, 665, 702, right? All of a sudden, they went from $600,000 to $700,000 by the rate dropping, which all of a sudden a lot more people are getting into the market again who can afford these homes, right? Which is great. Let's see if this is going to go for me. Okay, it's going to take a moment. But as rates drop, more people get into the market, right? And as more people get into the market, what happens? Prices go up, right? So a 1% drop in rates nationwide brings 5 million buyers into the market for a 1% drop. So if we go from 7 to 6, $5 million more borrowers. If we go from 6 to 5, another 5 million, right? 10 million buyers nationwide, 2 points of rate. That's a lot of buyers, right? So it's going to drive prices up. And because we know inventory isn't going to change significantly, prices are going to go up. All right, buy now or later, right? Should we buy now or should we wait for rates to drop? Great question, right? That's the question we're hearing a lot. It's like, oh, I don't want to buy it. I'm waiting for rates to drop. Okay, cool. Let's talk about that. So if you buy now, that house is going to cost you $600,000, right? At 6.625, right? Payment of $41.68. If you buy later, right, that house is likely to go up to $650,000 in the next 6 to 12 months, right? In Bend, that's not unheard of, really, especially in that price range. There's a lot more people in that range. Payment, now they got 6.125. Great, they got a lower rate, half a point lower in rate. Payment's $4,279 versus $41.68. Hang on a second, that's $111 less by buying now, right? Lock in your purchase price now. I'll fix your rate later. All right. Now, if they don't qualify for this, they don't qualify. That's a different story, right? Then we can work the math and say, all right, where do you need to be at? And I can show them this is where things need to be for you to qualify based on this current scenario. Or here's what you need to adjust to get there, right? If you've got extra debts, we need to talk about, hey, maybe you should work on this credit card, or maybe that car payment's a little bit high. Maybe you should think about getting a different car. How important is it that you have the house? Is it important that you have that $60,000 truck with a $2,500 payment on it, or that $1,200, $1,500 payment? Is that important, or is the house important, right? Sometimes you have to make some sacrifices, all right? And there's a lot of decent used vehicles coming back on the market finally, all right? So buying now versus later, right? And that's only a $50,000 increase, right? That's not a huge increase in price. Now, so if you buy now, I'm going to call you in 2 years. So you buy now at 6.625, right? The value in 2 years, value of your property, $675,000, right? $75,000 equity in 2 years, just in appreciation only, not even counting what you're paying down in interest or in principal. All right, 2 years, rates 5.5%. Fantastic, we love that, right? They're going to save $469 a month when we do that refinance, right? So versus if we go versus the buy later, and they got the lower rate and the higher price, sure, I can refinance them out of that too, but they won't be saving $469. They'll be saving about $375 roughly, right? So bigger difference to buy now, and then just we'll take care of your rate, right? So that's basically the nutshell of what we expect to happen. We pick next month topic, and it will show up before next month. The slide will show up, hopefully. There we go. Personal branding for real estate agents, right? How to help you create your brand and attract ideal clients in today's digital world, because everybody's online in some way or another. So yeah, hope you enjoy the tacos. I love Lucy's. I go there way too often because they're right across the street and they're good, and it's just yeah. It's like, well, tacos are healthy, right? It's just meat and veggies, right? And corn's a vegetable. Guacamole is from avocados, which is a plant, right? It's a superfood. Yeah, exactly.